Let's talk about JPMorgan Chase, the financial giant you see everywhere. Most people know them for credit cards and checking accounts, but their real power is in moving money at a massive scale. Banks like JPMorgan take your deposits and lend them out, fueling everything from small businesses to billion-dollar deals. They're a financial supermarket, offering loans, investments, and more. But with size comes risk. When they make mistakes, it's headline news. Lending is where things get interesting and risky. Every loan is a bet that the borrower will pay back with interest. To decide who gets a loan, banks do their homework, checking credit, income, and history. But sometimes, even the best systems fail. Banks don't just lend to people, they also lend huge sums to other lenders, who then loan to consumers. JPMorgan extended a massive line of credit to a company in the subprime auto loan market. That decision would soon lead to a costly, very public mistake. This is a story of big money, big risks, and a big fat write-off. The company in question? Tricolor Holdings, a Dallas-based subprime auto lender. Subprime means risky, loans to people with poor credit or low income, often at high interest rates. Tricolor focused on helping underserved communities get cars, but subprime lending is a dangerous balancing act. For a while, Tricolor grew fast and attracted big banks like JPMorgan. Then, in September 2025, Tricolor abruptly filed for bankruptcy. What happened? Economic pressures, and more troubling, widespread auto loan fraud. Allegations surfaced that many loans were based on falsified information. Suddenly, the assets backing JPMorgan's loan were worth far less than expected. It was a classic case of due diligence gone wrong. Tricolor's collapse exposed a major vulnerability in the system. The fallout was just beginning. After Tricolor's collapse, JPMorgan had to write off $170 million. In banking, that's admitting you'll never see that money again. For a bank this size, it's embarrassing and expensive. CEO Jamie Dimon addressed the loss bluntly. "It is not our finest moment." He admitted the bank's procedures failed to catch the fraud. The loss raised tough questions about JPMorgan's risk management. Even the biggest banks can get burned when safeguards fail. The incident exposed how much trust banks place in the lenders they fund. When that trust is broken, the consequences are huge. This wasn't just a financial hit, it was a blow to JPMorgan's reputation, and it signaled deeper problems in the wholesale lending market. Jamie Dimon warned, "When you see one cockroach, there's probably more." Tricolor's bankruptcy wasn't an isolated case, it was a warning sign. Other big banks like Fifth Third and Barclays also lost millions on Tricolor. This was a collective failure of due diligence. Multiple banks missed the red flags, suggesting a systemic problem. The fraud was sophisticated enough to fool teams of analysts. The Tricolor collapse showed how hidden risks can spread through the financial system. If it happened here, where else is it happening? The cockroach theory reminds us, one exposed problem often means more are lurking. The financial world was on high alert. You'd think a $170 million loss would hurt JPMorgan's bottom line. But the same quarter, they reported record profits, over $1 billion more than expected. For a mega bank, even huge losses can be absorbed. Still, the Tricolor fiasco was a wake-up call. The lesson? Rigorous due diligence is non-negotiable, especially in risky markets. Banks must strengthen their vetting and never take things at face value. For the rest of us, it's a glimpse into the hidden risks of modern finance. The Tricolor collapse was a warning. Even giants can stumble. But it also showed the resilience and the blind spots of the world's biggest banks. In finance, the next, not our finest moment, could be just around the corner.